I think silver could easily take out the old phantom highs at $50 in 1980 and 2011, which are, like ages ago. They're almost meaningless. Why? Because the real value of the currency unit over those decades to the present has decayed so much, you'd probably have to be $200 silver just to match the real value of silver in 1980 at 50, okay? But I think we're going to surge to 60 to 70 between now and the end of the year, which is, say, a handful of months. Well, and I think gold will go up during that time, but nothing like what silver is going to do. Now, is that the end of it? No, that's not the end of it. That's just an acceleration phase out of this underpriced metal.
Market analyst Michael Oliver, known for his momentum structural analysis approach, has taken substantial positions in silver through leveraged ETFs and mining stocks while maintaining minimal gold exposure. His aggressive positioning reflects confidence that silver will significantly outperform gold in the coming cycle. Oliver's core thesis centers on silver's outdated price benchmarks. The metal's previous $50 peaks from 1980 and 2011, when adjusted for inflation, would equate to approximately $200 in today's dollars. This inflation-adjusted comparison suggests silver remains deeply undervalued relative to historical standards, creating substantial upside potential from current levels. The technical analysis supporting these projections draws heavily on historical market patterns, with particular emphasis on the 1972 silver bull market as a roadmap for current price action. According to the research, silver could reach the critical $50 threshold by January-February 2026, approximately 7 to 8 months from mid-2025. As one market observer noted, the 1972 analog shows a particularly strong correlation to the current market. Silver could reach $50, then consolidate before the next leg higher. Oliver's near-term outlook is particularly aggressive, forecasting a surge that could push silver to $60 to $70 per ounce in the coming period. This projection is underpinned by his expectation that silver will significantly outperform gold, breaking away from the traditional correlation patterns that have historically linked the two precious metals. Looking further ahead, the projections become even more ambitious for 2027. Market forecasts suggest silver's price momentum will accelerate significantly, with the average price expected to reach approximately $60.40 per ounce. The trading range for that year is anticipated to be substantial, with minimum values potentially starting near $44.40 while maximum prices could stretch to $77.27 per ounce. Before we begin, make sure to like, share, comment, and subscribe. Tap the bell icon so you never miss our latest market insights and real-time updates.
Go back 50 years and find what was the, 21 of the 50 years, not even bull market years necessarily, silver reached 2%. Silver right now, percent of the price of gold, it'd be $60, $70. Divide, 2% of what the gold is. Gold's not stopping here. It's paused for 4 months, this boring sideways action. And it's going to re-engage as well. I think very soon you're going to blow out the recent highs and top pickers will realize, oh gosh, I messed up again. But silver during that 4-month period, what's it done? It's gone up nicely. It's gone sideways. So the spread is shifting, favoring silver, meaning gold sideways, silver's gone effectively vertical for the last, since the April low. April low is 27.50. We're now, 39.50. Okay, so quite a move. It's going to continue. And if silver merely returned to the 2% level, that would be right now standing still. It means it's going to almost double from where it is now relative to gold. So it's double better than gold right now. Silver merely returns to its normal relationship to gold. But in bull trends in silver and gold, like in 79, 80, 2010, 2011, the latter years of the bull trends, silver went 8 on the upside. It went up to 3, 3.5, even one time up to 6% plus the price of gold. And I say this is also going to be true with the gold and silver miners. They're going to outpace gold because they've underpaced gold for the last, since mid-2020. What we measure is the momentum of the market, and we don't use that noodle indicators that when you go to your computer screen, a quote screen, things like RSI or MACD, which everybody has for free on their screen, and they move like wet noodles, so to speak, up to a certain level and they drop to a certain level and like a little snake. A lot of people misinterpret the, let's say RSI is overbought. Well, that's next to meaningless because measuring a certain distance back in terms of what's normal for overbought or what's normal for oversold. Get into dynamic bull trends. You can go back and research this yourself. Punch up a monthly or a weekly RSI of gold to silver. But during the massive surges, like 79 to 80 or 2010, 11, those readings got rammed to the roof. They were overbought for maybe 5-6 months straight in a row. And that's the time you made the most money. They were, quote, overbought. What we look at is structure of momentum. And by that, I mean plot momentum. What we do is we take the price action, like a bar chart of price, weekly, monthly, whatever. Usually we're focused more on long term. Plot it in relationship to certain long-term moving averages. We don't overlay the average on price chart. That's next to meaningless. You get above it or below it. When you oscillate it, you get either above the average or you're below it, and therefore you're either on the plus side of an oscillator or the lower side. And it builds a chart, like a price chart, that looks different. Quite often it'll smack you in the face with its clarity of structure. Meaning, for example, right now we look at the stock market, and you see this upward curve week by week. It's not explosive, it's just arm wrestling, but it still goes up every week. But when you look at a momentum chart, repeated lows at a 3/4 average, a zero line on an oscillator, such that you can tell if you ever break that floor, you're going to puke. The price chart, you don't see it. On silver, for example, we had a structure that, last May of last year, silver reached 32.70, surge high, leveled off and oscillated fairly violently for a year. May, June of this year, you could draw a line from that 32.70 and it got above it and got below it in violent swings, but really it was lateral. The price, it looked like a mishmash. Plotted a momentum chart of that. We had a perfect parallel downtrend channel that anybody didn't even have to be a technician. You could see this beautiful wave corrective phase that silver was going through on momentum. Prior to coming up and blowing out those two price highs at 35 last year in March of this year, we came up through there in June. Late June, early June, we get up above 34 again. You weren't at the old highs. And that structure on that momentum chart was blowing out, saying, I'm out of here. Okay. So it's no surprise that so went from 34, 35, 38, 9, almost 40. And I think it's just begun. I think you asked a while ago about, what did the technical show for soon, let's say. Between now and year end, it is our assumption, my personal investment assumption, and I do show my positions. They're not the size, but what markets I'm in our reports at the tail end, I show what I own. And I'm heavily emphasized in silver, double silver ETFs, and silver miners. Much lesser extent, gold and gold-related miners. Silver could easily take out the old phantom highs at $50 of 1980 and 2011, which are, like ages ago. They're almost meaningless because the real value of the currency unit over those decades to the present has decayed so much, you'd probably have to be $200 silver just to match the real value of silver in 1980 at 50, okay? But I think we're going to surge to 60 to 70 between now and the end of the year, say, handful of months. Well, and I think gold will go up during that time, but nothing like what silver is going to do. Now, is that the end of it? No, that's not the end of it. An acceleration out of this price metal.
Global central banks collectively hold over 35,000 metric tons of gold, more than 1.2 billion ounces, representing nearly 20% of all gold ever mined. At $3,000 per ounce, these reserves total $3.6 trillion, underscoring gold's strategic monetary importance. Gold's bear market performance extends beyond safe haven flows. During major downturns, gold outperforms as central banks respond with rate cuts and liquidity injections to support economies. Analyst Michael Oliver notes that weakening markets generate poor data, prompting aggressive Fed easing as seen in 2000 and 2007. Crisis performance follows a predictable pattern. Gold initially faces selling pressure as investors liquidate for cash, exemplified by its 34% correction in 2008. However, recovery typically outpaces other assets. Following 2008's decline, gold began a multi-year bull run that more than doubled pre-crisis prices. prices. The Federal Reserve policy drives gold's price action through interest rate expectations. Dovish signals like rate cuts to combat inflation or weakness often spike gold prices as the metal becomes attractive relative to yield-bearing assets. Hawkish policies signaling rate increases create headwinds as investors rotate toward higher yields. Let's get back to the interview.
We look at the technicals. I mean, I know what the fundamental story is. It's the ongoing degradation in the money units, fiat currencies. Doesn't matter which one. They're backed by nothing. And ultimately, over time, gold and silver hold their value for an investor. In recent years, silver's lagged gold. In other words, they both made major lows in 2015 and have advanced significantly since in an arm wrestling manner. In other words, it's been, if you're too focused on what this month or next month's going to do, you're panicked out of the, every other month. And there's many technicians out there who encourage you to exit the market because it's a top or it's going to correct big, et cetera. But actually, it's been now 10 years and gold has gone from 1,050 to 3,500. So ongoing with it had a 20% correction in the middle of that. But silver has lagged, especially since 2020. Silver reached up just below 30 and then pulled back from 2020 to 2023, while gold really went sideways, and therefore silver underperformed gold. That's changing, and I think it could change dramatically. And if you go back and look, for example, 50 years ago, and look at every year and figure out what is the price of silver in relation to gold, divide 1 ounce into 1 ounce, and what is that percent? And you'll find that 21 of those 50 years, silver was at least 2% of the price of gold. But right now, silver is 1.16% of the price of gold. It's coming up from a low that was below 1%. So silver recently has been very, very low. So you ask about silver, I think its prime dynamic right now is it's going to catch up to the mama metal. Mm-hmm. And it's going to outpace it. It's going to be the better place to be, especially, I think, between now and the end of this year. But I think it's indicative of the initial wave of doubt that there is in the U.S. stock market. No, it got up, made a new high recently. We're extremely negative on the U.S. stock market. I think it's been topping since late 24, early 25. We're marginally above those highs, but I still think it's topping. But that money goes somewhere. And historically, if you go back and look, at major bear markets in the stock market, you'll see gold did quite well. In fact, it was one of the few places to be during those bad periods. And to some extent, that's not just because money's moving out of the stock market and seeking a new home. It's also because central banks, whenever the stock market starts to implode, they will naturally start to cut rates and do anything they can to liquefy the system, to protect those assets that they deem worthy of protection. They don't care about commodities. Heck with commodities. Corn farmers can go broke. We don't care if price goes up there. But we got to keep the prices of stocks. Also, when the stock market turns down, that's when the data points, things like unemployment or economic indicators are indicating the weakening in the economy. That's when the data points go south. So the stuff that Powell's talking about that he needs to see before he can cut, bet on that happening after the stock market starts down again. And that's when they'll start to do what they always do. And if you go back and look at 2007 top, 2000 top, the dot-com, before the market really started to implode, the Fed started cutting rates. They'd been on pause for a year or two, and then they suddenly put pedal to the floor. Let's print the money. Let's do QEs, whatever. It did not help the stock market. That money flow went into monetary metals. And it's not that gold had to wait for that event because it's been rising for 10 years. Again, it's an issue that over decades and decades, gold holds its value to the degrading money. And all you got to do is look at an M2 Federal Reserve St. Louis State Public. Okay. It's just like an upward
go back
ballistic
to economics,
missile.
macro 101.
Yeah, in other words, they're destroying the money unit. It's backed by nothing but hopes and wishes and lies. And gold holds its. Young kids today haven't learned that, but their granddads knew it. And so the granddads no doubt told, you should buy gold. Well, now maybe the kids are starting to realize maybe I should have. I think we're at that point. But I think it's going to be different. I do have a pretty solid assumption, philosophically based on my libertarian views and what I've learned in time about gold. This time, gold and silver are going up, but they're likely not to come back down. In other words, you're not going to get a bull market peak and a major bear fall. This time, I think the global outcome, the U.S. outcome in particular, economically speaking, monetarily, will be totally upset to assumptions, to institutions, and to a lot of investors who don't realize what's going on. This is not a normal boom-bust cycle. This bust will not be normal in the stock. It is based on a 15-year bull market, one of the oldest in U.S., in fact, the oldest bull market in U.S. history, printed in place by M2 growth and Fed funds rate taken to zero for 10 or 15 years. And even after they upticked, a year or so, it was at levels that are in the lower quadrant of the past 75 years of rates. So we've had effectively free money for 15 years. Well, that's like getting drugs in you get hallucinated, you make decisions on that, you hire employees, you build new factories, you make all kinds of positive assumptions based on the underlying value of the money, it's rapidly decaying, but the nominal value seems good, and the money, the cost of money, a factor in any business. Heck, it's, or next to, so errors are personal core government, and compounded. Not only is the age of the bull trend like triple any prior bull market, it's increase in price, the multiple gain is far than the 23 to 29 or the 1994 to 2000 .com or the 2002 to 2007 peak that preceded the mortgage crisis. There's no comparison. So we have the biggest bubble, especially in U.S. market now. I'm talking about a lot of other markets that don't have bubble. But when it's in our lap, and that's the biggest lap to be in, because when we expunge the errors that occurred in that period of time, the damage will be global. Gold knows what central banks are going to do. That's what they do. They print, they save their governments, they try to save their government debt markets. They take any steps they have to that continues to distort the underlying real value of the money in your gold is the only alternative, and silver. And therefore, this time around, I think at the end of this, I think it's going to be institutionalized. I think we're going to end up with gold-backed currencies and silver-backed potential around the world, here, there, and pretty soon, once this crisis hits full blown, then people will say, this hasn't been working. Let's go back to gold. So instead of a bear market next time, you'll have gold as institutionalized.
Silver and gold continue to shine as key havens amid growing market instability and central bank intervention. While stocks appear vulnerable to renewed weakness, these metals are positioned to benefit from policy shifts and decline in fiat currencies. With momentum building and long-term patterns favoring upside, silver and gold may be entering a phase where they reclaim their historic role as reliable stores of value and engines of wealth preservation. Is silver preparing for a breakout that could surprise the markets? Share your thoughts in the comments below. If you enjoy this video, don't forget to like, share, and subscribe. Hit the bell icon and turn on notifications to stay updated. Your support helps us continue delivering the latest market insights to you and the entire community. Thank you for tuning in.